So I'm here with Steve Kaplan from the University of Chicago, world-renowned expert on private equity, and I guess we're going to chat a little bit about private equity and research. But you, I guess, started doing private equity research already from the beginning, right? Tell us about what made you go into doing research in this area.
So private equity started as leveraged buyouts really in the early 80s. And just as it's controversial now, it was controversial then in that people didn't understand it. There's a lot of leverage, which scared some people. And there were a lot of questions about, what did it do to the companies? Was it good or bad? Did it create value? How did investors do? And so that was a great thing to study as a PhD student because no one knew the answer. People wanted to know the answer. There were real academic issues. There were policy issues. And so I started doing research then. And on and off, but usually mostly on, I've been doing research ever since.
And Mike Jensen, I guess, was the first academic who kind of started thinking about this, and he was your advisor.
Mike Jensen was thinking about these things, and he was doing it somewhat anecdotally and somewhat theoretically. So he sort of said, I think these things make a lot of sense. I think these buyouts are a better model of incentives. And but he didn't have the evidence. And so basically, I went out and got the evidence.
I mean, it's interesting because I guess when you started doing research, that was probably at the peak of the first, let's say,
wave.
Yeah, wave, and then there was a downturn, and I guess people, I don't know if it was the case in the early 90s. Okay, this buyout thing is now a thing of history. This was a hype, and then it's been coming back. Then we had the late 90s, there was another peak and drop, and then we had, before the GFC, peak and drop, and so on.
And then in the GFC, you may recall, a lot of people said buyouts are done and will never come back. So it's very cyclical.
But I guess one of the things that's sort of striking when you look at your research early on, and we did some stuff together and so on, is sort of like how everything just seems to repeat itself, right? I mean, the waves, the performance. I mean, it's pretty stable.
Yes and no. What's been interesting is some things repeated, some things didn't. So the cyclicality is there for sure, and that I think has to do. The M&A markets are very cyclical too. What didn't repeat is that the private equity firms don't do the same stupid thing twice. So the private equity firms have been actually very smart over time in getting better. So first example, in the late 80s, they did deals with 90% leverage. And like in the recession in the late 80s, early 90s, 30 or 40% defaulted. Oops, that doesn't make sense. So 90% leverage never happened again. And actually since then, the leverage has been coming down. It was like, it was like 70% in the 90s, and really in the 2000s it's been 50, 60%. Now leverage about 50%. So the leverage came down. Then I think the downturn in the late 90s, early 2000s, there weren't many, the defaults weren't a problem, but what they realized they had to do something differently, and I think that's what happened starting in the early 2000s. Operational engineering really picked up, and you and I wrote about it in sort of that 2009 paper. And then the great financial crisis happened, and remember, in the great financial crisis, there were a lot of reports. I mean, there was I think it was a BCG wrote this thing. All these companies are going to default. It's a complete disaster, and they didn't. They actually maneuvered through the great financial crisis reasonably well. And then since then, they've really, invested a lot in their value creation teams. And so the operational engineering piece has just gotten much better over time. And, we'll see what happens going forward. So you have this cyclical, but there's been this sort of consistent improvement in their processes and I think in their value creation.
So when we did our in our 09 paper, and this I think was something you had already seen in the data before that. We found this relationship between, okay, when private equity is very popular, a lot of money going into the industry, then performance tend to be somewhat worse. And then when there's not that much money going into the asset class, performance seems to be better. Is this a pattern you think is persisting, or is it sort of weaker than we thought?
I think that's weaker because I think the sort of relative to public markets, kind of the worst performance was 06, 07, 08. And 07 is when the most money went in on a relative basis. But a lot of money has been going in, to 2010 to now. A lot of money came in, and the performance has been very good.
Although relative to the stock market, I think you showed that the peak is still 06, right? Normalized by
the amount of money coming in.
So
it's 07, but it's still the amount of money coming in like 15, 16, 17 actually was close, and it was and the performance has remained very strong. Now we'll see with interest rates going up in a recession what will happen, and you heard today there were different opinions about there's some who think the valuations are inflated, some who don't, and I'm more on the positive side, but time will tell.
And I mean, you also have done some more work on that, seeing where at the deal level, because I guess one of the things, just look at the vintage of fundraising, well, that money has to be deployed over a number of years. But I guess there's still some evidence, right, that deals done in tougher environments when it's harder to get leverage and so on, well, you get them cheaper, and that in itself can be a contributor to performance, no?
I mean, you would think that the lower multiple you pay on an absolute basis, again on a relative basis, if you buy it at a low multiple and then sell it at a higher multiple, the stock market's also gone up.
Yeah, that's true.
So you've got
PME-wise,
it's not as clear. And again, the thing that's the counter argument to that, and the thing that makes it tough is, deals in 2014, 2015 were done already at pretty high multiples, and those deals have done well.
I mean, one dynamic that I thought might play in here, though, is that if you have these very active fundraising environments where a lot of big very easy to raise funds grow in size, it's also very easy to borrow, then you get a lot of competition, right? And you get money starts burning in your pocket a little bit. If you raised, you have 5 years to deploy this capital, you might have a tendency to kind of, a lot of competition, to underwrite this deal, I really have to jack up leverage and so forth, and maybe do deals that on the margin are not that great because I have money to spend. And then in tougher environments, well, you have to be more, people are sort of more disciplined and do more, you can't underwrite the deal just based on leverage, you have to have a better operational case.
We'll see. Again, what's interesting, you would have said, and this is what we found in the paper I wrote with Greg Brown and David Robinson and a number of other co-authors, is that in real time it's very hard to figure that out. Like looking backward, you can say, oh, that was the peak and that was it. But in real time, and this is again the 2010 to 2021 story. You would have said in 2015 or 2016 it was overheated because it went like that. Those deals had done really well. Now it kept going up, and I think what you will find is the 2021 vintages where they did a ton of deals, the absolute performance is not going to be great. I still don't know about the relative performance because the stock market is way down since then. So the relative market, it's a horse race, but the relative returns will be a horse race, but the absolute returns will not, or likely won't be good.
Actually, one of the things that would be interesting to hear your thoughts about is this persistence in private equity that you early on in your paper with Anton at SHoF, you had these sort of persistence results. Then you've done other work on that. And I guess the thing that was interesting with persistence is this is on a net of fee basis, right? So you can't just explain it with someone being better, because why don't they then just increase their fees? But I guess, what's your view on that now? Because I know some of the recent research on persistence is not as strong.
So on the buyout side, what you find on persistence is it's much weaker than it used to be. And what persistence means is when somebody is out raising a fund, you say, I want to invest in only the funds that are at the top, like usually top quartile. So I'm going to put my money in a fund that the previous fund, let's say fund 3 is top quartile, I'll invest in fund 4. If you do that, if you take the funds that are raised, top quartile, second, third, bottom, and then look at the next fund, how they perform, there's not much difference at fundraising. And so if you're keying on the performance at fundraising, it doesn't work.
Like the investable persistence.
What you can invest.
Sense,
What turns out is that if some of these funds that were third quartile end up top quartile, and that does persist a little bit, not a ton, but it persists. But you don't know that at the time unless you know how that portfolio is going to do. So that's, I think, one reason persistence is it's harder because you don't know at the time they're raising. People tend to raise funds when their previous fund is doing well. And sometimes they stay well, sometimes they don't, sometimes the other ones move. So that's a moving target. I think the other thing that's also in the data is funds that are at the bottom and stay at the bottom never raise another fund.
So they drop out of the sample.
So the bad performers, who are probably not so good, drop out. And so you end up, the ones that get raised, you're competing with the good ones. So that sort of makes persistence a little bit harder, that the people who remain are good, and it's hard to know at the time what the actual performance is, and so you don't see a whole lot of persistence. And I think a third reason is that usually you're buying the whole company, and so the highest bidder wins. So you don't get so much what you get in venture, where there's more persistence, is I will I'll take money from a Corriendum or a Sequoia because I think they're going to make me worth more, because I'm only selling 20% of the company. When I'm selling 90%, or 100%, I want the highest bidder.
Right, that's a good point. Now, one of the things I think that would be interesting to know, though, is that these persistence results are basically just looking at, performance, PMEs or something like that, in the previous, or IRRs. And then does that persist? But I guess if you're a good LP, you might actually go in and dig deep down and actually see what the have a better projection, I guess, of what's going to happen.
And that's what the fact that there's persistence when you find out the final results of the fund suggests that there's some that there can be value from doing that.
So Steve, it's been a pleasure having you here. Please come back soon, thanks for making the long trip to Stockholm.
Good. Well, thanks for having me. It is always a pleasure to visit and spend time with you.